All right, we're back. First part, we looked at income statements and balance sheets and highlighted certain things on there. And if you look, so far we've used almost every one of the line items I had you highlight. There's only a couple that we haven't, and I'll use those shortly. And then I looked at ROI is the ultimate goal, profitability, and then the pyramid or the triangle coming on down, and that was the DuPont company that organized that thing. And make certain you can explain all of that process to me. And then the second step is what I call the manager's dilemma. And that's where we need to have profitability. We got to have that profitability, but the assets that are most profitable are the ones that are least liquid. So we have to maintain some minimal level of liquidity. And what we have are two measures of the amount of liquidity. So we have two measures of them. And the first measure of liquidity is called the current ratio. And we're going to do a variation of this next week, but for now, for this week, we're going to call this the current ratio, and it's the ratio of current assets to current liabilities. It's real simple. So current assets are the assets we can turn into cash fairly quickly. And current liabilities are the bills that we're going to have to pay fairly quickly. And let's see, we would like this a ratio of 1 current assets to 10 liabilities? No. And think about it. You look in your checkbook and you got $1 of cash in your checkbook for every $10 of bills that you got to pay. That might be what your checkbook looks like, but that's not a good way to have it. Do you want to have just as much cash in your checkbook as bills? And that's not really good because sometimes more bills come in than... So the rough approximation, 2 to 1. Not saying every company runs that and all that other kind of stuff. We'll see some actual data on that in a little bit. But just the rough rule of thumb, 2 to 1 is a generally accepted thing. Not if you get 1.88 or 1.69, maybe you're okay. 2.2, you're okay. You don't want a 10 to 1 though. If you got a ratio like 10 to 1, you got way too much current assets for the bills that are coming due. That's like walking around with $10,000 in your checking account and having $1,000 worth of bills coming due. Doesn't make a lot of sense. So you want to have enough, but not too much. So one of this, the liquidity is it's like the mama bear and the papa bear and the baby bear. You know, too hot, too cold, just right. We want it to be just right. So okay, not too hot, too cold, just right. Current ratio. The second ratio is another measure of liquidity. It's called the quick ratio. And don't write this down, but it's the quick assets over current liabilities. Huh? What do you mean by the quick assets? And the answer to that is it's the cash, the short-term investments, maybe I didn't have you highlight short-term investments, did I? If I didn't, you probably have to highlight that. I didn't. Highlight it. Yeah. Short-term investments and receivables, net receivables. I'll do that on camera just a bit. All over the current liabilities. Gee, that's probably the first mistake I've made all semester. Right. All right, yeah, I didn't have you do that. Here, bring that in tight for me here just for quick. That's good. Wrong highlighter. There. That was the one I didn't do. Sorry. We'll back up on that. Now, what this is it wants to look if things really get tight and you have to pay your bills really quickly, can we do it? Remember, cash was cash. Short-term investments were things like, really short U.S. government securities, things like that. Get them into cash real quickly. And then accounts receivable. And next week we'll study it a little bit, but accounts receivable, if we need, can be sold for cash. There's a business out there, there's a whole process within business that buys up accounts receivable. And I'll cover that next week. So all of these are really, really, really liquid. Inventory is not. Because inventory, we have to sell it, we have to find a buyer, we sell it, and then we have to wait 30, 60 days for someone to pay the bill. So inventory is not considered a quick asset. But cash, short-term investments, and receivables, all of those are considered very, very liquid. Now, as a rule of thumb, we would like to see this one about 1 to 1. Somewhere in that range. Don't want to see it 1 to 10, don't want to see it 10 to 1. It's roughly 1 to 1. If you got enough quick assets to pay your bills, you're probably in pretty good shape. So if you got enough cash and quick assets, don't worry about it. You can pay your bills. So that's manager's dilemma. And I want you to analyze, say, okay, when you get done, liquidity looks okay. Compared to profitability, they're in good shape. Or they're really scratching it. They're not in good liquid shape. Or, make some comment as to how they've handled how that dilemma was handled. And then the third, see, I told you these things would go quickly once we got by profitability. The third one is financial leverage. And there's two things that we look at under financial leverage. The first thing is the amount of financial leverage. And you know the answer as to how we measure the amount of financial leverage. It's called the debt equity ratio, or D/E, or DI, or however you want to write that or read it. So we find out how much financial leverage, and do I need to write that down? Maybe I better write that. Total liabilities and total stockholders' equity. It was those two lines I had you highlight on the liabilities plus ownership side of the balance sheet. So that's the amount of it. Now, if you remember the last couple of weeks, when I talked about financial leverage, I said one of what financial leverage causes is financial risk. And we would like some measure of the amount of financial risk. The way that that is done is called the times interest earned. If we make that an acronym, what do we end up with? TIE. So we have the die and the tie. Okay, that's where they come from. Okay. The die. Times interest earned is also known as a coverage ratio. And it's equal to EBIT, which stands for earnings before interest. So I'm just going to write EBIT, and everybody knows to write down earnings before interest and taxes, divided by I, where I is the same I. So if this is earnings before interest and taxes, this is interest. This is interest. Now what if this ratio is 1 to 1? Earnings before interest and taxes. So really the cash flow that the business is able to generate, or the operating income, maybe is a better way of phrasing it, the operating income that this business is able to generate is just equal to the interest cost. Is that a good situation? No, that doesn't leave anything for taxes, and it leaves absolutely nothing, which is going to upset the government, but it's going to leave nothing for earnings. So when this ratio is low, low ratio means a high risk. Low ratio, high risk, high financial risk. What if this ratio is 10 to 1? Now, there's no problem with the amount of debt they've got. Their business is generating plenty of money to pay off the interest costs. So you don't have to worry about it. So a good high ratio. Now, you don't want it, well, maybe you do want it 5,000 to 1 or something, but I mean, that means you haven't borrowed hardly any money. But normally speaking, somewhere around 7, 8, 9, 10 to 1 is what companies run. Now, there's a small number of companies that don't borrow any money. Microsoft has no long-term debt. It has some short-term debt, but really has no long-term debt. It has effectively no interest costs. So their coverage ratio is infinite. Their times interest earned is essentially infinite. They don't have any leverage, so their debt equity ratio, long-term debt anyways, is essentially 0. If this ratio goes less than 1, now their operations are not generating enough money to even pay the interest costs. So now they're losing money. Now they're losing money. And if it goes negative, I don't even want to talk about that. Well, that's what all that's all about. Okay, let's take General Electric. Now, what I want, let me come straight ahead just for a couple of seconds. You're going to give me a 3-part report. The first part of the report is everything I just said for the last hour or whatever that was. Condense it down. Don't just give me an outline, but explain it to me. Well, essentially what I want you to do is write something that you could give to someone that has never had this class, and that person would understand the McCarthy system. So if you have a spouse, write it, have them read it, and if they say, yeah, I understand it, then you're probably pretty good shape. If you have a secretary at work or whatever, you've got a fellow student, somebody, just, if it's something, if they're looking at, huh, what did you say? Then you probably got some holes in it, kind of thing. But now, how long that has to be, there's no fixed limit. It just, from reading hundreds of these over the years, it's pretty hard to do it less than 2 pages. And don't make it so long that I need to get some caffeine in me just to make it through it or something like that. So give me a break too, but make sure you don't leave things out. Because what I see a lot is when it comes time to explain it, people go, profit, oh, gotta have profits, ROI. Sometimes they'll say, maybe they talk about profit margin and asset turnover, and then they'll stop. They won't give me any explanation. I think I spent a long time talking about all this stuff. I want to hear about it. So don't leave anything out. You're going to have probably 16, 18 ratios, 19, 20, depends how your company breaks out stuff. And don't leave any of them out of the explanation. Cover them all. And don't just listen. Oh, then we do boom, 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 boom. Well, why? What are you doing there? So make sure you list the whole thing out. All right, let's look at GE. I went through this afternoon and I calculated these ratios for GE. I'll give you the numbers I used and the results I got. So A, you can have some numbers to back check against if you don't understand what I did. And then B, I'll try and give you, the first part was a written analysis of McCarthy. Second thing, it's the numbers, what I'm going to do right now. The third thing is an analysis. So I'm going to do the number calculation and the analysis simultaneously. You can do it all simultaneously. You can say, I want to explain ROI, then calculate ROI, and then analyze it. And then you can do, or I want to explain profit margin and asset turnover, calculate them, and then analyze them. Or you can do 1, 2, 3, the whole thing. Any combination you want. Just don't copy from someone else. Okay. For GE, the very first thing was profitability. People that are good in Excel go through these numbers really quickly and do this. They'll set up a file where they go through all the line items that I've highlighted, and then they'll just click onto the formulas, and it goes real quickly. Other people like me, they handwrite them, and it still goes pretty quickly. So in either case, this is not a long process. ROI was, what was that again? Net income over total assets I'm going to suppress the last 3 zeros that they gave you all the way through there. Hopefully that doesn't upset anybody, but I don't want to write zeros forever. So it's 14,151,000,000 was their net income, and they had 242,000,000, and I got that at 1.973%, less than 2%. Is that a company that's doing spectacular? Well, you know, one of the interesting things about American industries, I've been doing this for a long time. If you get to double digits, you're spectacular on ROI. You would think that we do better than that, but very few companies over long periods of time do 10% or greater in ROI. 2% is not good. It's certainly better than negative, but you won't find an awful lot of them with much more than 5, 6, 7%, which is kind of scary when you really think about it. They don't come up with a better ROI than that, because you would think, I would have, without doing this stuff, I always thought it'd be like 15, 20%, but it's single digits. So this is not good, but it's not horribly out of line. Next thing I look at is profit margin. And profit margin was net income over total revenue. And that was at 14,151,000,000. Total revenue was 147 billion. And 9.6069%. Give me at least one decimal point when you do these. I don't care if you give me 2 or 3 or 4, but give me at least one. Now, without making the next calculation, what do you think my asset turnover is going to be? Well, this times my asset turnover is going to get me that. So it's going to be somewhere around a quarter or something. It's really going to be small. And they got a really small, slow asset turnover. Most companies, it's closer to 1 or higher. So here my asset turnover, it would be my total revenue. I'm going to just go TR for total revenue over total assets. It's at 147,300. And assets of 717 billion, 717,242. And that is exceptionally low, 2054. I use times. You can write that, whoops, I'm sorry. Wasn't paying attention. That's all, I'll leave the insert in. I'd rather have that in. 2.205 times. You could write that as 20% if you want. So it's either 20% or the times here means it's an index number. That's just Neil's notation. Most students today don't even know what that means. I guess I'm showing my age. If you went 0.2 times 9.6, you're going to be down to that 1.97. So what kind of a company is GE? profit margin. Very, very low turnover. Very, very low turnover. Very high. That's pretty good profit margin, incidentally. That's a very good profit margin. So, but they don't sell enough for the amount of money they've tied up into assets. So your analysis would be that ROI is on the low side, and their profit margin is very good. Their turnover is very, very low, and the net result is that their ROI is not as high as you might like to see it. Okay? So something like that. Some kind of analysis. Profit margin. What about the profit margin? Where did their money go? Analyzing that. It was cost of revenue over total revenue was the first one there. I'm going to go down each of the line items. Some of you are going to have a much smaller list, and some of you might have a little longer list. I've got 71,190 cost of revenue, 147,300, and that's 48.3299%. Now, that number is not necessarily good or bad. When I get all done, I'm going to be talking about, we not only analyze this number, we look at it over time. If last year it was 45% and the year before it was 41%, that's not good. If it's going from 41 to 45 to 48, that's not good. What do we want to see? You want your costs going down each year as a percent. You want your costs down. So you want this one just to go down a little bit. So going up is not good. Going down is good. So it's over time. And we're going to do this you're going to do it for 2 years worth of data, and you're going to say 2 years is a significant long-term trend. Because I'm not going to make you do 10 years worth of data just to watch you punch numbers. So we'll do it that way. Cost of revenue. And then it's selling, general, and administrative expenses over total revenue. 37,384 over 147,300, and that was 25.3795%. And once again, that number is neither good nor bad. What do you want to see on this one? You want the trend going down. You want the trend going down. The non-reoccurring. I don't really know what that even means. Non-reoccurring means not going to happen again. Fine. What does that mean? Over total revenue. It's 4,083 over 147,300, and that's 2.7719%. I have no comment to make on that. I have no idea. But it's a number that we're going to need as part of another calculation. What we do care about is our interest expense. Over total revenue, and that's 14,545 over 147,300. And let me tell you, folks, that's huge. 9.8744%. Almost 10% of their revenues went to paying interest costs. Think about that. 10% of your income goes to paying interest costs. Would that hurt? Yeah, that would hurt. I guess maybe if you had a mortgage on a house, maybe 10% would, but that's still a big bite, isn't it? That's still a pretty big bite. So for a company, that's a huge number. Income tax to total revenue. 5,732 over 147,300. 3.8914%. What were we using for? Well, this is on a total revenue, not on profit. So I guess that's not a fair, but that's a fairly low income tax rate. That's a pretty low tax rate. 3.89%. Once again, it's the trend on these things is what we want to look for. There's a couple other ones in there. There was minority interest. Over total revenue, and that was almost inconsequential. $292 million over 147,300, and that's 0.1982%. And then the last one is discontinued operations over total revenue. And that was 77 over 147,300. And that's equal to 0.052 sequential. If you wanted